Is your trading psychology holding you back? It almost certainly is. And today in this video, I'm going to help you completely solve it. I'm going to help you create a mental environment that is literally conducive to profitable trading, using scientific evidence-based examples to help you do this. If you have been struggling with what you believe your mindset towards trading, your psychology, anything related to that, this video is going to help you structure things in a very clear and simple way so that it puts you in the type of position where you can make better trading decisions and help you get profitable. So if you're not yet profitable, yes, your trading psychology is almost certainly holding you back. And yet, the solution is so simple. Your brain literally works against you in trading because we didn't evolve in an environment that was designed to help us learn how to make good trading decisions. Here's why mindset is 90% of trading. And things like charts and technical analysis and fundamentals is the other 10%. You can have a perfect trading approach, but still lose money. Let's say, for example, I give you a very simple trading approach. I told you to buy at support and sell at resistance. And then what you inevitably do is you go to the charts, you find as many support and resistance zones as you can, and then you start buying and selling. What ends up happening is you start taking a lot of trades that start veering away from what the very, very simple trading approach is. You might start buying before price gets to a resistance zone because you think price is going to continue up into a resistance zone. And you don't know where to put your stop loss, so when it goes against you, you add to the position. You don't have any sort of clear risk structure or proper position sizing. You may sell at a resistance zone and then everything looks perfectly fine, but before price gets to your profit target, you end up closing early. And so your trade ends up running to your original target. And so your profits are small and your losses are bigger because you'll hold on to losing trades longer. So even if you quite literally have a perfect, optimal, ideal trading approach, you can still lose money because of the decisions that you make in the context of that trading approach. The second thing here is that trading is not all about charts, and as a matter of fact, it's mostly not about charts. I've said this for years, is that simply waiting for the proper setups, waiting before price gets to your profit target to close a winning trade, waiting until price paints certain candlesticks on the chart that shows evidence that price might not go to the target and it's going against you to then close the trade early in a loss or at the stop loss. Being patient is quite literally a huge virtue in trading. And if you're not doing this, then what ends up happening is you get the results that 90% of people get, which is the case that 90% of people lose money because trading is risky and most people do in fact lose money. Since trading is not mostly about charts, it is mostly about the way that your mind interprets the data that you're seeing. The kinds of things when you're looking at technical analysis and buying at support and selling at resistance, and then interpreting those things in a way that allows you to craft a view of reality that is aligned with your best interest. Now what we're going to do is we're going to cover all this bullshit that you're going to have to deal with on an endless basis, and we'll put an end to it all here with this video. So keep watching, we're going to get more into it. There's a couple things to know, and we're going to focus on the three most pain in the ass psychological pitfalls that's going to completely destroy your profits. So the first one here is the fear of missing out on impulsive trades. It's essentially just the urge to jump in late or overtrade. Now let's define these terms because I see a lot of people saying things like fear of missing out and over trading, my psychology is not right. Let's actually put a little bit of groundwork and definitions into these words that we're using. So what does it mean for you to have fear of missing out? What this means is that say price has gone into a resistance zone and then it already starts bouncing away. And so by the time you wake up the next morning and see the chart, price is already away from the area that you would have entered at, right? Whether you're using trend lines or support resistance or any other trading strategy, we're just talking about a place where price did set up, but then you were not there to place the trade, so it ended up running away. And now you're getting this feeling, this urge, I should just jump in. Even though now your stop loss is going to have to be further and your profit target is going to have to be shorter. Whereas if you would just wait for trades to enter like at the optimal area where you had pre-planned you'd enter, what that means is you'll have a better risk structure, right? The stop loss distance can be smaller and the profit target can potentially be bigger in a lot of cases. Whenever you have fear of missing out, you end up entering the trade anyway, even though it's not an ideal risk structure. And then if it goes against you, you might not even have a plan. You might say, okay, I might just add again if it gets to the resistance zone. And then what happens if it goes against you from there? Now you have two losing trades that might represent maybe double the loss that you would have originally lost had you just waited for an entry at the area that you had originally planned for. Fear of missing out screws over a lot of traders. Let's not make it be you. I'm going to give you a couple more systematic things throughout this video that you can do. Next, let's talk about overtrading. Overtrading is essentially the idea that there's a trade that you really know you shouldn't get into, but you take it anyway. That's all overtrading is. Overtrading is taking a trade that does not align with either your technical strategy, so I mean just your trading approach, if like, it's a trend and I'm waiting for a pullback before entering, or I just take support resistance trades, but it's not at a support resistance zone. And then on top of that, you have to combine that technical aspect with the idea that you have to use your intuition. So it's like, you see a setup that might be viable on the chart, but then your intuition's telling you something else. You get a weird feeling, like this weird feeling in your gut that like, I don't know, this doesn't seem like right. It doesn't seem like, yeah, it's at resistance, but it's already bounced here a couple times. And I actually think it's going to break past the resistance, but instead I'm going to still sell at the resistance. Things like that are over trading. You're taking a trade that doesn't feel right, okay? Now, I know that you're not going to feel perfect about every single trade you take, but that intuition is very powerful because it's your brain taking all the information that you've seen and the experience that you've got trading, putting it all together, and then it presents itself as a feeling. We just call that discretion or intuition or using my gut or using my best judgment, things like that. Once those things come together, the technical aspect and then the intuitive aspect, you can then find trades that align with that. And if you take a trade that does not align with those things, yes, you are over trading. And that's a retarded thing to do. The second part is revenge trading and doubling down. It's a completely destructive cycle of trying to recoup your losses immediately. You get into a trade, and then after you get into the trade, it starts to go against you. So instead of you thinking, you know what, maybe I'll cut the trade here, and then I'll sit on the sidelines, and then I'll watch. I'll do the responsible adult thing to do. I want this to be a nice trade I can bring home to mom and dad. I don't want this trade to be a complete hoe. I want it to be really nice. But instead of you waiting for things like that and closing losing trades early and holding on to winning trades longer, you're like, nope, it has to go, bro. The further it goes, the more likely it is to turn back. And I used to say this same stuff. So believe me, trust me at face value. The more price goes in one direction, yes, the more likely it is to pull back. However, that doesn't always mean that it's the best decision to add unless you're doing it in a very structured and systematic way. For most people who are dumbasses, probably yourself, because most people, including me, are dumbasses, and we have to be doing these little bullshit mental gymnastic exercises to keep us in check so that way we don't make stupid trading decisions. What you need to do instead is not double down. If you lose a trade, don't add to it. If it starts going against you, just close the trade. Whenever you take the next trade, what you can do is you can risk slightly more if you think it's a more optimal entry and if it reflects your risk tolerance. But do not just start doubling your risk and adding and adding and adding with zero plan for how you're going to manage the trade. Because if you do that, it might work out a good portion of the time, but you're going to be exposing yourself to a lot of additional risk. And on top of that, the one time it doesn't work out is going to blow your account, which is okay, but it needs to be done in a very systematic, structured way. And if you're watching this video and you're not yet profitable because you haven't got your psychology in check, you're probably not the exception to the rule here. So it's a better idea to just not really add to losing trades unless, of course, you test it out and you get years of experience. Then in certain cases, it's not the worst thing in the world, right? I don't want to speak in absolutes here, but I'm just speaking in a generalized sense. Do not double down on your trades. Stupid idea. The final part we're going to cover is overconfidence and neglecting risk. When a winning streak leads to reckless decisions. It's Monday morning. You've just placed your first trade. Starts going into profit. You add to it and you move the stop loss for the original position closer. Goes into more profit. You add to it again. It goes into more profit and it dumps and dumps and dumps and dumps into more profit. Then you close the trade into profit. $70,000 of profit. This is what happened to me at the beginning of this week. I made $70,000, technically, $68,000 of profit in one trade. Please excuse the extra $2,000. I didn't make that extra $2,000. I can't say I made 70. I made $68,000. I call all my trades in my private group. I'll put a link in the description if you want to follow them. I'm going to straight up plug it shamelessly. You should follow my trades. We're up like $170,000 over the past 3 weeks. But what happened afterwards is that I started getting a little bit like catty. I started getting a little bit like, price has to drop here. And so the next trade I went into, I noticed that I had the urge to risk more. I'm like, you know what? I could risk $70,000 on this trade. And then if this next trade works, I'll make $70,000 profit. And so then that would be 70K on that trade plus 70K on the first trade. I'll be in profit 140 grand on the week. Or I will lose this next trade and I'll lose 70 grand. And so I had that impulsive desire to be like, bro, I'm relatively jacked now. I've gained a lot of weight back. I'm literally sitting in front of guns. My testosterone is up 30%. This trade can't lose, bro. I'm just going to enter it. I'm just going to be overconfident and enter it. And then this nasty little creature inside me got jumped on by my wisdom of all the 9.5 years I've been trading. And it jumped on that thing and started ripping it apart like a wolf devouring a little rabbit. or or something like that. And instead of making the impulsive decision to risk $70,000 on that trade, you wanna know what your boy did? Your boy risked 20K on it. I risked half as much as I normally risk because I recognized I was starting to get overconfident. What happened to that trade? I lost it. I lost 20 grand on that trade. You know what happened to the next trade I took? I lost 20 grand on the next trade too. You know what would have happened if I would have taken $70,000 risk on both of those trades? I would have lost $140,000, counting the 70K profit on the week. Instead of being up on the week 70K, I'd be down. I would be down 70,000 on the week. But because I wasn't a complete dumbass, instead, I'm still up on the week, almost $30,000. As you can see right here, this is the group, MFX Nix Trades. Again, this is where I call all my trades out. Again, the link is in the description. You should go join it if you want to follow my trades. You can see this first trade right here, I made almost $70,000. Then I lost 20K on that. Then I lost 20K on this next trade. I risked less because I knew that I was starting to get overconfident. And instead of being down $70,000 in net P&L on the week, I'm still up $27,000 in the week, and profit is profit. Not to mention, as of literally right now, I'm holding these two trades on GBP-CAD and GBP-JPY, and that's up another $10,000 right now. It pays to not be a dumbass. Don't be a dumbass, and don't let you being overconfident lead to reckless behavior, which causes you a losing streak right after you've had a beautiful win streak. Now what we're going to talk about is understanding your apish, retarded chimpanzee brain on trades and the neuroscience behind emotional decisions. Your amygdala's role in your fear and greed response. You and me and all of our thousands of generations of ancestors before us evolved on the African Serengeti plains. We have this thing called a brain, and in it we have this thing called the amygdala. The amygdala is what sends a bunch of signals to release things like cortisol and adrenaline and norepinephrine into your body so that you can run the f away when a lion starts chasing you. Or in some cases a hippopotamus, since hippos technically kill the most people in the world than any other big land mammal. Your amygdala helps quite literally keep you alive, and it works so great for things like that. If you're getting chased by a lion in the middle of the Serengeti, someplace in ancient Africa, works great, helps you survive. But in trading, your amygdala releases those same fight or flight chemicals into your bloodstream when you start seeing a trade go against you, or when you start seeing a trade that you could have entered go into profit and you get a FOMO response, or when you see a trade go into profit and you feel the urge to want to take the profit early because you're afraid it's going to turn against you and you're going to lose what you already have. Your amygdala is great in general, but it's very maladaptive for trading. And it causes you to do stupid, foolish things that make zero logical sense and that do not align mathematically and statistically with profitable trading decisions. Another thing is your primal lizard brain instincts and how that influences your dumb trading decisions. Just like your amygdala, what will happen whenever you get all these chemicals coursing through your body is you will make decisions that you literally can look back on and have zero clue why you made. Dopamine in the pursuit of the quick wins is why you're going to chase those short-term gains, and it's going to cost you long-term profits. And again, this is not because it's a bad thing to have your brain and your emotions. It's a very good thing, in fact, generally speaking in life. But in trading, whenever you let those emotions impact your trading decisions, and you do not develop through habit, through ritual, through practice, the level of self-awareness necessary to be able to catch yourself in the moment you're about to make a dumbass decision and stop it, then what will happen is you will let those fear responses and those emotional responses impact your trading in a negative way that is not conducive in any way, shape, form, or fashion to profitability. Cognitive biases in trading. Confirmation bias, anchoring, and trading just because you feel like trading. Confirmation bias impairs so many people in trading because we want to be right. If we were right a long time ago about the fact that we'd be able to kill this big animal to be able to eat it, and we're hunting it with our spears, if we were right about that, it allowed us to be able to kill that animal so that we could get some food. But if we were wrong about that, we could die. If we were trying to hunt a woolly mammoth and it was just me against a woolly mammoth that's fully grown, 10 years old, and a male, full of testosterone, that shit would have killed me. I would have died. It would have been stupid. So being right is very important when it's a life or death situation. But when it's trading, you're not going to die if you lose this next trade. Unless, of course, you take, the house mortgage and risk it all on some sort of USD CAD sell last year at the end of 2024, and you end up losing a lot of money on that. And then your wife ends up divorcing you and you get really upset. And so you want to go and self-delete because you're so unhappy with the situation. I don't want you to wind up there. So that's why instead of doing that, you have to recognize when your brain is trying to find information to confirm what you think is going to happen. Your brain will actively seek out information to try to make you think that you're right, even if you're wrong. And now, how do you get around this? You have to develop self-awareness. You have to look at evidence. You have to be scientific about your decision making. You have to learn to trust your judgment after you get enough experience to dictate that your judgment has the merit to be trusted, because it can be relied upon for getting good results long term. And when you're doing all things, it allows you to be very selective in your trading. And then in fact, you don't look to confirm your beliefs. You will seek to disconfirm your beliefs, essentially. You will try to find information to the contrary, so that way you have a lot of good reasons to not get into a trade. But whenever you do have really good reasons to get into a trade, your brain will notice that, and then you can just take those trades. Instead of just looking at any chart for any reason and saying, I think it's going to go up, now let me try to find some information that supports that bias. Confirmation bias will ruin you as a trader, and it'll also ruin you in a lot of areas in life. This next part is anchoring. So anchoring in trading is just simply, you rely too heavily on the first piece of information you get. So if you saw somebody, maybe like me, posting in their Discord channel, I'm selling AUD CAD and I'm putting my stop here and my target here, just like I did earlier this week. It was a pretty nice trade until it didn't work out. And then what you'll do is you'll use that. Then when you go to the chart, you'll see, okay, Nick said he's selling, so you're just going to be looking at it through the lens of a seller. You're going to be like, I'm going to try to find reasons why this looks like a good sell. And instead, you're completely going to ignore information for why it may potentially be a good buy. And so what you have to do to get around this is you have to recognize that just because the first piece of information you receive presents itself does not always mean that that's the best piece of information, nor the only piece of information you should rely upon. You should look at a couple things in combination. You need to examine the context around the trade you're taking, all the little adjacent reasons. Then you need to ask yourself, like, what is my intuition telling me? Do I get a weird feeling about this trade? Would it be better to pass it up? Would it be better to wait for a better entry? Things like that. Do not trust the first piece of information you see. And this last part is trading just because. You're bored. You're sitting at home, you have Zen pouches lining your tongue, and you're wondering what the hell you should do because you haven't taken a trade in the past hour. And you've only had 124 trades for the day, and you got to get that next fix. You got to get that next trade. And so you go to the charts, you click, click, and then you find something. You know what? GBP AUD on the 10-second chart looks like it's in an uptrend. And I think I'm just gonna buy because it's in an uptrend, bro. And so you buy, no clue what lot size you're using, no clue about position sizing, no clue about like how much you're gonna risk for the trade, no clue about where the stop loss should even go, no clue about even using a stop loss in general, and you buy, and then it goes against you and you get scared and you immediately close the trade. Boom, congratulations, you're certified dumbass. You had no clue what you were doing, you went to the chart, and you just traded just because you were bored. You have to be able to become self-aware as when that's happening. That way you can learn to walk away from the charts. You can close your phone, close your laptop. You can go away. Then you can come back at a time when your brain is at peace. Then you can make decisions that are in your best interest because your brain will actually be in a spot for you to make those types of decisions in a proficient, effective way. All right, we've talked about all the bullshit that's causing all this. Now let's go through some practical strategies for not completely losing your mind trying to trade profitably. The first thing here is journaling and post-trade analysis. You have to be able to objectively evaluate your decisions and learn from those mistakes. I should know this firsthand because back in 2016, which was my first year of trading, I lost money for a whole year. When I started doing my taxes at the beginning of 2017, I was like, holy shit, I lost over $8,000 last year. And in 2016, I only made a little over 20K for the whole year working. And that was 2 jobs, 65 to 80 hours a week at different parts of the year. That was very heartbreaking, especially because I could only write off 3K in losses at the beginning because of US tax law. And that really killed me. So what I said, you know what I'm gonna do? Instead of being a dumbass, I was already a dumbass, and I actually still am a dumbass to be fair. But it's okay, you're probably a dumbass too, so we could be dumbasses together, but we can still make money if we're doing this the right way. So what I decided to do instead is, number one, I decided to not trade with live capital ever again until I was profitable in demo for a couple months. The second thing is I told myself I'm gonna have to work my ass off driving Uber and then working my job at Target. I was a little security guard there and working my job at a church doing security until I made $8,000 back. It was technically $8,300 that I'd saved up so I can save up what I lost again. And that was really painful. So it worked really hard. I traded in demo and I tracked my trades in the notes section on my phone. I had an Android phone. I think it was like a Samsung Galaxy. And what I did is I started a little notes section of that phone and I would take a screenshot of every trade I took and I would put it there in the notes section of that phone and I would put one little sentence as to why I took the trade. Then when the trade concluded, I'd put a screenshot about, how it concluded, whether it was a profit or loss or break even. And then I'll put what happened and why I closed it there if I closed it manually. And then what I did is I started seeing some combinations between the winning trades and what they had in common and what the losing trades had in common. As I learned from this, I was able to find where I was essentially screwing up and not making the best decisions. And then I was able to fixate and focus more on the things that were actually conducive to good profitability. So essentially just like a set of little basic conditions to wait for before entering a trade. And then you compound this the more experience you get. Your brain starts to recognize it instantly in your subconscious mind before you can recognize it in kind of your conscious awareness. That is why the first thing that we tell our clients to do at Mission FX, which is my coaching program, we've had over 4,500 clients. The first thing we tell them to do after they finish the lecture content inside the program is to start a trading journal. And they start it on Discord. And what they do is they put a link to the chart image on TradingView for the trade when they entered, and then what it looked like when they closed the trade, and they put a one-sentence explanation, just like I did when I got profitable 7 years ago. What this allows us to do is my team and I then go into their Discord server and we give them instant feedback. So we speed up this process. That way they're not looking at it on their own, clueless, right? They have me and my team, we go in, we make little screen recorded YouTube videos to help them structure that. And we show them, look, you're doing this is what happened. We also notice that whenever you do this, that tends to work out a little bit better. So focus more on that. Draw your zones like this, update it. Then they go through the next day of trading and back testing and live testing and forward trading or forward testing on a demo account. And they start taking more trades, and we get to give them feedback instantly every single day. But that's the first thing we tell them to do, is to start a trading journal so that we can analyze the data, analyze their decisions and their actions and what the results were, and then be able to optimize for what seems to work best. We essentially show them how to do more of what works and less of what doesn't based on objective data. And you know I have to tell you about this. If you want to get mentored by me and my team, hit the link in the description. There'll be 2 links. The first one will be for my private trading group where you can just follow all my trades. But that second one, it costs a couple $1,000s, but you can do a whole month of mentorship with me and my team. You can do 1 month, or if you pay us a little bit extra, we'll do 2 or 3 months. And we'll literally help you one-on-one every single day, me personally and my team. You get unlimited one-on-one access to us. As many calls as you need, as many questions as you have in the little the Discord server. If you think that would help you, then hit the link in the description below right now. Just kidding, wait till the end of the video, then you can hit it after the video. The second thing is mindfulness and emotional regulation techniques, so staying calm under pressure. I learned what I'm about to teach you here from a Navy SEAL. There's actually a video of a Navy SEAL on YouTube, but you know, it sounds cooler when I say I learned it from a Navy SEAL. It is called iterative decision making. Whenever you are under pressure, your brain starts running into a million different scenarios. I entered this trade, it's starting to go against me. What if it starts to break the zone? What if it comes back? What if I size too heavily? What if I don't even know what size I put at all? I didn't even put a stop loss. Where am I going to close the trade? Where am I even going to close it in profit? Your brain starts going down a million different rabbit holes. Iterative decision making says, you know what? We're in a shit position right now. Let's just take the one next logical step that we know is probably right. And we don't know where this is headed. We don't know exactly how it will play out. And we have no clue what the final outcome will be. But at least we know what a step in the right direction is. Then you focus on doing one thing that you can do to at least get yourself in the right direction. Here's an example. When you start noticing that you're getting really excited because you're on a win streak, and on the next trades you're wanting to say, like, you know what? I don't need to risk $100 per trade anymore. I'm going to risk $10 million on my next trade because I'm on a win streak and I can't lose. You have to become self-aware and notice that that's a stupid, dumbass decision. And then that next step for you, that one next step would simply just be saying, you know what? On this next trade, I'm going to risk the same dollar amount I normally do, or perhaps even I'm going to risk a little bit smaller, maybe half of what I normally do, because I recognize I'm getting into an altered emotional state and I might be making decisions that are kind of stupid. Iterative decision making is very powerful because it simplifies things. Instead of you having to think about a million different things and all these different outcomes and being worried and paranoid and anxious and obsessive and having a panic attack where you're trying to be trading on these damn charts, instead, you will make one decision that helps you get it one step in the right direction. And then from there, you'll then reanalyze the situation and say, okay, I made the right decision there. Now what is the next step? And by doing it one step at a time on an iterative basis, right? It's iterative way, iterative decision making. That's why it's called that. You get the point. Like it allows you to make decisions in a very iterative way. It's constructive. Let's go to the next thing. The power of reasonably sized wins and consistent execution. So we're essentially going to be building positive habits over time instead of chasing insane trades with stupid risk to reward, like 1 to 69 risk to reward, or 1 to 420 risk reward, or 1 to over 9,000 risk reward. Stupid. By having predictable wins that are reasonably sized, and all this means is like even if it's a 1-to-1 risk to reward ratio, that's something you know you can hit at least 50% of the time given enough trading opportunities. Why? Because even if you have no clue what you're doing, if you just enter a trade, you risk the same dollar amount for every trade, and you put a stop loss wherever the hell you think you should, you put a target at a 1-to-1 risk reward ratio, half the time it'll hit stop and half the time it'll hit target. And if you do that, you can start noticing what the winning and losing trades have in common. Then you can slightly start getting your win rate up to maybe from 50% to like 60 or 65%. Now you have an edge. Now all you do, if you just every 10 trades you take, you make anywhere from 1 to 2 units of profit after every 10 trades. You take 100 trades, you make anywhere from 10 to 20 units of profit. And if you're risking $1,000 per trade, after 100 trades you take, which you can get over the course of like a couple months, you can make like $20,000 profit. If you're risking $1,000 per trade and you're coming out in 20 units of profit after every 100 trades on average. That's amazing. That's beautiful. But those small, consistent wins, and again, I hesitate to call them small. That's why I put the reasonably sized wins. Those reasonably sized wins means that you're not trying to shoot for the moon, right? You're not trying to be ridiculous here. You're not trying to like enter a trade that has like a 1 to 10 risk reward ratio and you're taking loss after loss after loss. That'll kill you emotionally and psychologically. If you can handle that shit, be my guest. Me, my other 4,500 clients that I've worked with over the past 7 years, we think it's kind of retarded. So maybe you shouldn't do that. Instead, focus on doing reasonably sized wins. Take your profit whenever price gets to like a 1-to-1 or a 1-to-2 risk reward ratio when you're starting. And then as you get more experience, you can look at extending your risk reward ratios, extending your profit targets, cutting losing trades early, things like that. All the little dynamic decisions that are influenced by your intuition. All right, let's wrap this up. You have to shift from emotional reactions to strategic discipline. So let's talk about cultivating patience and discipline. There's a lot of long-term benefits to having a structured, simplified trading approach. When your trading approach is very simple, you know that whenever, like let's say for example, you trade like me, and if you're not, you should trade like me because my trading strategy is the best. I call it the Nick Sean golden bullet strategy. We're not doing silver bullet trades here. That's for losers. That's for the posers who have no clue what we're doing. We're doing the Nick Sean golden bullet trading strategy. I take my AK-47, I load it with a golden bullet, and I shoot my computer in the chart. Okay, let's actually get into it. So I just trade support and resistance. All I do is I draw a support resistance zone above price and below price in the daily chart. When price gets to one of those areas, I buy or I sell. It is dirt simple. It is dog shit simple. It is so simple that you and your grandma and your dog and my dog all together, collectively, could do it easily. And whenever you keep things so simple, what ends up happening is that it becomes very easy to predictably do over time. You end up learning how to be really patient waiting for good trades because you're not looking at a million different metrics and you don't have to bend the rules a million times waiting for, well, you know what, price actually is resistance, but it could be here and it could be there. And so I'll just take a trade right now. And you start justifying these things with all sorts of mental gymnastics. When things are really simple and structured, it allows you to just wait for trades that are quote unquote good. And all that means is that they're a trade worth taking, right? It's an optimal trade. It has a good risk reward ratio. And it has a good risk structure. It has an optimal entry for, it's either going to go straight into profit or straight into loss, and you can manage it very easily. Things like that. You have to be able to wait for trades like that. And you can only do that consistently if you have a very simple trading approach. This next part here is embracing losses statistically and understanding random distribution. You have to shift your perspective on losing streaks. Did you know that getting a losing streak of 5 trades or more over a set of 100 trades is statistically likely to happen? It's a very, very, very high percentage chance that you will lose 5 trades or more in a row given 100 trades with a 50% win rate. If you have a $5,000 account, you're risking $1,000 per trade, you're going to blow your account in 5 trades. Now, you're also going to have win streaks where you win multiple trades in a row and you'll be dancing up and down and you'll be so happy. But for some reason, when the same thing happens just on the other side, you get all sad and depressed and you think trading is a scam and you're never going to do it because it's stupid. That little trend strategy, the Nick Sean support resistance golden bullet strategy. I tried that and I lost 3 trades in a row, so it obviously doesn't work. I'm on to the next one. Random distribution dictates that you are going to be losing consecutive trades in a row at some point throughout the discourse of you taking all the trades that you take. And whenever it comes to this, what you have to do is you have to embrace it, right? There's no way that you can get around it. Like even me, like there's trades, I've taken a 2 trade losing streak this week. There was one week where I still came out in profit, but I only won 1 trade. I took 4 trading opportunities. I only won 1. 25% win rate. I lost 3 trades in a row. And then I was still able to come out of the week in profit. You have to make sure that whenever you do hit a losing streak, you don't lose your mind. You have to understand it's a part of the process. It's a part of trading. And whenever you do have a consecutive losing streak, recognize it's just statistics. It's going to happen at some point. And then whenever you take multiple wins in a row, if you were that worried about winning multiple trades in a row or losing multiple trades in a row, whenever you win multiple trades in a row, you should be getting paranoid and scared too. But you don't, because it feels good to win, but it feels shitty to lose. Recognize that multiple wins and multiple losses in a row is a part of trading. It's going to happen. And so whenever you do have a losing streak, just let it happen. As long as you're not risking too much per trade, you're going to be fine. Just keep going. The final thing here is taking trades that, quote, feel right and not ignoring your intuition. You have to become self-aware of your fear response and allow it to serve you in a productive way. I talked about this earlier in the video, but just because you use your intuition, your discretion, your gut feeling to trade with, doesn't mean that you're trading emotionally and that it's a negative thing. Yes, intuition is an emotion, but so is every other damn thing. You're looking at a chart, you see a resistance zone, and you feel like selling. That emotion, you have that emotion to sell. We're trying to structure things in such a way that you can then rely on that intuition to produce profitable trading decisions long-term, given enough trades. And you can't ignore that in trading, right? It's gonna, like I said earlier in the video, it's gonna come from a part of the technical side of things. You're gonna have to look at the chart, you're gonna have to do this and that, draw a little stupid support resistance zone, do a little risk reward thing, buy, put a stop below, target above. But after that, you also look at it and you let that intuition play as a piece of the puzzle, right? It comes together as a piece of the pie, and it comes in and it presents itself and says, hey, all the technical parts of this make sense, but it doesn't feel right. So you don't take the trade. That's not trading based off fear and emotion. That's trading based on common sense. If it's a dark part of town and in like a shitty area where you live, the area I live is beautiful, but you go across the highway, complete shithole. When you go into a shithole place and you're walking there around 2 a.m. and you just feel like going on a walk and there's a bunch of like people standing out around, there's a high crime right there. You get a weird feeling like, maybe I shouldn't be here. But then you tell yourself, but technically, it's illegal for somebody to beat the shit out of me or kill me. In reality, you get a feeling that kind of presents itself that's like, maybe I shouldn't be here right now. Maybe I just shouldn't come here like ever again. And let's go walk on the nice part of town on the other side of the highway, like where I live. Got a nice little beautiful neighborhood here. And even then, I probably still wouldn't go out at like 2 a.m. at night on a walk, just because it's that feeling you get. Like you have to be able to like kind of read the situation. When you use that in trading, it serves you well. That's all I got for you today. If you liked this video, then I would appreciate if you did whatever the hell you want to do. Links in the description if you want to join my trading group and if you want to apply to get coached by me and my team. I love you, and I'll see you in the next one, my friend. Mwah.